Welcome to The Explainer. Today, we're diving into a really big shift in hotel finance, one that completely changed how companies report some of their biggest costs. We are talking about IFRS 16. Now, I know that sounds super technical, but trust me, its impact is massive, and we're going to make it all make sense. So let's just start with a question. What if a hotel's largest financial commitments, I'm talking about the lease for the entire building, were basically invisible on its main financial report? It sounds wild, but for a very long time, that was the reality. And that's exactly why this whole accounting change was so necessary. So here's our game plan. First, we'll look at the old world of off-the-books leases. Then, we'll get into what the IFRS 16 mandate is all about. After that, we'll see the pretty dramatic makeover it gave hotel balance sheets. And finally, we'll figure out what this new reality actually means for everyone involved. All right, let's jump right in. To really get a handle on the new rules, we have to kind of go back in time and see how things used to be done. It's the only way to understand the hidden problem that started this whole thing. You see, back in the day, accounting rules basically split leases into two different buckets. You had your finance leases, think of those like a loan to buy something, and they went right on the main financial statement, the balance sheet. But then you had operating leases, and this is the crucial part. Most long-term hotel leases fell into this category, and they were kept completely off the balance sheet. They were treated just like paying your electricity bill every month. And this is where it gets really significant, because we're not talking about leasing a printer here. We're talking about the entire hotel building itself. The restaurants, the vehicles, staff housing. These are enormous, long-term financial commitments that were, for all intents and purposes, invisible in a company's main financial snapshot. So you can see how this lack of visibility was a huge problem, right? Especially for investors who were trying to figure out a company's real financial health. That's why regulators stepped in and introduced a new global standard to fix it, IFRS 16. At its heart, IFRS 16 is all about one simple idea: transparency. The new rule says, look, if you have a long-term right to use an asset and you have an obligation to pay for it, that deal has to be on the balance sheet. It's basically saying no more hiding. So how does this work in practice? Well, now, when a hotel signs a big lease, it doesn't just get noted down as a simple monthly expense. Instead, it triggers two brand new entries on its balance sheet, entries that completely change the financial picture. So let's take a look at what they are. First, on the asset side of the books, the what you have column, the company records something new called a right of use asset. This basically represents the economic value of its right to use that hotel building for the entire length of the lease. And of course, to balance that new asset, the company adds a lease liability on the what you owe side. This is, for all intents and purposes, the debt the company just took on. It's a formal recognition of all the future rent payments it's legally obligated to make. Okay, so we've covered the theory. Now let's see what this actually looks like in the real world. How does this rule really transform a hotel's financials? This is where you can see the numbers start to make some serious moves. To make this really concrete, let's just follow the journey of a single monthly rent payment, say $100,000, and see how its treatment has been completely flipped on its head. Okay, now this is where it gets really, really interesting. Look at this transformation. Before, that $100,000 was just a simple operating expense. After IFRS 16, that line item goes to zero. Instead, that payment gets split into two totally different things. Part of it is now depreciation expense on that new asset, and the other part is interest expense on that new liability. So, why does this matter? Well, this reshuffling has a huge side effect. Because rent is no longer an operating expense, a really common profitability metric, EBITDA, now looks artificially higher. The hotel isn't actually making any more money, but the accounting sure makes it look that way. So let's visualize this for a second. This is a very simplified before picture of a hotel's balance sheet. You've got some assets, some liabilities, pretty standard stuff. But what's missing? That giant multi-million-dollar obligation for the building lease, it's just not there. And now look at this. This is the after picture. Under IFRS 16, the whole balance sheet just balloons in size. Both the asset and the liability bars shoot way up to reflect that newly recognized lease. The company suddenly looks a lot bigger, and also a lot more in debt. So now that we have this new, more transparent financial picture, what do we do with it? What does it all actually mean? how are investors and operators supposed to read these new statements? It really boils down to four key things to watch out for. We've already seen the EBITDA inflation and the balance sheet expansion. Well, that also leads to higher leverage, or debt ratios, and it creates some new headaches when you're trying to compare a company that leases its hotels to one that owns them. So the big takeaway for anyone looking at these financials is that you have to see both sides of this new coin. On one hand, yes, the hotel might look more profitable because of that higher EBITDA. But on the other hand, it also looks a whole lot riskier because all that once hidden debt is now sitting right there in plain sight. And if you only remember one thing from our time here today, please let it be this. The underlying business is exactly the same. The actual amount of cash the hotel pays in rent every single month has not changed one bit. The only thing that's changed is the accounting. It's just how that cash payment gets reported. And that really leaves us with a bigger question to chew on, doesn't it? This whole shift is a powerful reminder that the financial reality we see on a spreadsheet isn't always reality itself. It's a story, and that story is shaped by the rules. And understanding those rules is the only way to really see what's going on.